In 2018, the European Union released its Action Plan for Financing Sustainable Growth. The goal of the action plan is to steer capital flows towards sustainable investments in order to achieve sustainable growth. To accomplish this, the EU has rolled out a number of new guidelines and regulations to help manage financial risks that stem from environmental degradation and social issues. They're also meant to encourage transparency and long-termism in financial and economic activity. The Sustainable Finance Disclosure Regulation, or SFDR, is one such regulation, and one of the pillars of the EU Action Plan on Sustainable Finance. In this video, we'll be discussing what the SFDR is and how it impacts asset managers. First introduced in 2021, the objective of the SFDR is to promote transparency in sustainable investments and make it easier for investors to make comparisons. It requires asset managers and other financial market participants to disclose the environmental, social, and governance characteristics in their investment products. Under the SFDR, asset managers must disclose the processes they use to integrate sustainability, how they consider adverse impacts, and their methods to align investment products with their sustainability objectives. The SFDR classifies funds into three categories based on how they consider sustainability factors: Article 9 funds, Article 8 funds, and Article 6 funds. Article 9 funds, or dark green funds, target sustainable investment as a primary objective. These funds must follow stringent reporting requirements that prove the product does not in any way harm the objectives of the EU taxonomy, another pillar regulation of the EU Action Plan on Financing Sustainable Growth. Article 8 funds, or light green funds, are funds that have specific sustainability criteria. They promote environmental and social factors and have good governance principles alongside non-ESG factors. The classification rules are less stringent than Article 9 funds. While sustainable investment is not an objective of the product, it remains an aspect of the investment process. The final category, Article 6 funds, have the least stringent requirements. For these funds, asset managers must disclose how sustainability risks are integrated into their investment decisions. If they deem sustainability risks not to be relevant, they must explain why. As part of all of their disclosures, financial market participants must disclose their principal adverse impacts, or PAIs. A PAI is any impact of an investment decision that results in a negative effect on sustainability factors, such as Scope 3 emissions or respect for human rights. The SFDR completes its final phase rollout in June 2024. From this point onwards, disclosures under the SFDR require a year-to-year comparison between reference periods. The SFDR is a complex regulation, and asset managers will need to account for the time and resources it takes to learn and implement the requirements. Individual members of the EU will set penalties as they see fit, but there are other compliance risks. Firms that fail to meet the regulations, or are accused of greenwashing, may see damage to their reputations and financial position. Thanks for watching. Learn more about how investors are impacted by reporting regulations and how they are mitigating their greenwashing risks on the Sustainalytics Resource Center.